You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Haleon, Coca-Cola HBC, GlaxoSmithKline, Aston Martin, AB InBev, and our US company of the week is Upwork. Sam, shall I kick us off with Haleon?
Absolutely. How's Haleon doing?
So, continuing to do well. They had their Q3 trading statement out, and I know we've introduced and covered it a few times before, but for anyone who doesn't know, Haleon is a relatively new company, and it's essentially the consumer health division that was spun out of Glaxo a couple of years ago. It has brands including Sensodyne, Aquafresh toothpaste, Centrum supplements, Otrivin, Voltarol, Panadol, and a few other smaller brands in that sort of consumer health category. In terms of their Q3 trading statement, then, revenues saw organic growth of 6.1% in the third quarter, and this was driven by both price and volume mix in broadly equal measure. All product categories and region were in positive territory, and organic profit growth came in at 7.4%, outpacing revenues, helped by an improvement in the gross margin, which more than offset high single-digit growth in advertising and promotional costs. Organic sales growth is guided between 4 and 6% for the full year, which remains unchanged. And although profit growth was some way behind the 11% seen in the first half, Haleon says that it is well on track to meet previously upgraded guidance in the high single-digit growth for the full year. And the shares were broadly flat in early trading. In terms of valuation, Haleon has a market cap of £32.85 billion and trades at 19.6 times forward earnings, with an average since listing of 17.2, and it has a yield of around 1.8%. I thought these results were very good, and certainly when we look back at Reckitt, which is probably the most similar company listed on the FTSE, I think initially we had questioned Haleon. It had come out with quite a lot of debt. That is coming down, and the revised net debt to cash profit level is around 2.5 times. And the numbers have been positive these last couple of quarters. It really doing well. I think that is reflected in the valuation, and personally, I don't think I'd be paying 19.6 times forward earnings for this business. I would prefer a Unilever, for example, and I think they've got better brands. I think the area of consumer goods they're in is probably more resistant and just overall stronger brands. But I think credit to management, they're doing a really good job. It's interesting linking it to Unilever as well, because this was a business that when it was spun out a couple of years ago, Unilever were rumoured to be making a bid for of around 50 billion. As a Unilever shareholder, a big relief that they didn't go ahead with that, and that did ultimately lead to the downfall of the chief executive at the time. On its own, Haleon doing really well, and I think it's looking like it will continue the positive trend going forward. Sam, what are your thoughts on Haleon and its current valuation?
I think these are a really good set of results, and not the first good set of results we've seen. I think since it was spun out, it's put up better results than I would have expected. Compared it to Unilever, I think the results are not that dissimilar to the Unilever results we covered a few weeks ago. They're definitely better than Reckitt Benckiser, Nestle, and PZ Cussons results. So I think, yeah, it's one of the better performers in the industry. And I think management have done a really, really good job of it since it's spun out. However, I wouldn't pay 19.6 times earnings for it. Yeah, I just think it's probably a bit too expensive for me, especially with those brands. I think it's a bit too expensive, but the company can't help the valuation it trades at, and the results themselves are excellent.
Moving on to Coca-Cola HBC.
Yes, so another business that we've covered multiple times. For anyone not familiar, this is Coca-Cola Hellenic Bottling Company. So it is basically the Greek arm of Coca-Cola. It's got the bottling license and distribution license from Daddy Coke, and it operates in a number of countries, but most of them are developing and emerging markets, although it does have some markets in Central Europe that are actually developed. So I should mention as well, we cover it every time, but although it is Greek, it is listed on the FTSE because they moved over from Greece in about 2005, I think. They have come out with a third quarter trading update, and organic revenue growth was 13.9%, with year-to-date organic revenue growth of 13.7%. Organic volumes are at 4%, with all segments contributing. Growth is led by the strategic priority categories, with sparkling up 3.9%, energy up 28%, and coffee up 35.6%. Organic revenue per case was up 9.5%, driven by targeted revenue growth management initiatives. Reported revenue growth was 8.9%, with strong organic growth partially offset by FX headwinds in emerging markets. And they've highlighted ongoing value share gains in non-alcoholic ready-to-drink and sparkling for the year to date. If we split them by region, so in the established markets, organic revenue was up 3%. In the developing markets, organic revenue was up 12.6%, and they've said that was led by revenue per case expansion and a positive volume performance. And in emerging, they've said organic revenue was up 24.1%, driven by revenue per case expansion as well as good volume growth, despite a challenging environment in several markets. They've updated their guidance ranges for 2024, and they're now expecting organic revenue growth of 11 to 13%, and that was previously 8 to 12%. On a comparable basis, cost of goods sold per unit case should increase low single digits, and that was previously expected to be low to mid single digits through the combined effect of inflation, transitional and translational effects. And organic EBIT growth is expected to be in the range of 10 to 12%, and that's up from 7 to 12% previously. If we split the results by beverages, or types of beverage anyway, organic volumes grew by 4%, with growth across the strategic priority categories of sparkling, energy, and coffee. So the sparkling volumes grew by 3.9%, and trademark Coke grew by low single digits, and Coke Zero grew mid-single digits, thanks to their partnership with the Coca-Cola company to capitalise on the summer with music and sport, particularly in the out-of-home channel through the season. Fanta grew mid-single digits with growth across all segments. Innovation remains critical to drive consumer recruitment, and we launched new Coke Creations flavours and Fanta Beetlejuice in the period, while also benefiting from Marvel activations in targeted markets. Energy volumes grew by 28%, with good growth across all segments. In established and developing, growth was driven by Monster, with the ongoing rollout of Monster Green Zero. In emerging, we saw continued strong growth of Predator and Fury in Nigeria and Egypt, respectively. These are such aggressive names. Predator and Fury.
I like them.
What you like? It's manly. Coffee volumes grew by 35.6%, with strong growth in all three segments. Growth of both Costa Coffee and Cafe Vergnano, I don't know how you pronounce it, continues to be driven by the out-of-home segment in line with our plans. And still volumes grew by 3.4%, water grew mid-single digits, while juices declined low single digits. Sports drinks continue to grow strongly, up high teens in the quarter, as we leverage the Olympic Games with Powerade and continue to place dedicated Powerade coolers in key markets. Ready-to-drink tea grew mid-single digits in the period, driven by strong performance in developing. And they said organic net sales revenue per case grew by 9.5% in our European markets. The contribution from incremental pricing reduced relative to the first half. However, in Africa, it remained the main driver of net sales revenue per case growth due to actions to mitigate ongoing inflation and currency devaluation. In terms of the valuation, the business trades at a PE of about 19.5 and has a dividend yield of 2.8%. I thought these results were absolutely fantastic. We've talked before about why we like this business. We've talked before about the resilience, how well they dealt with basically their Russia and Ukraine markets being obliterated a few years ago. Very, very resilient business. I think these numbers are far higher than I would have expected when we started covering it. I think we'd always liked that it was Coca-Cola, but with an emerging markets play. Admittedly, the margins aren't quite as good because they're having to pay Daddy Coke over in America, but you're getting that Coke brand, and I think it's quite a lower risk way of getting that emerging markets exposure. I think for the energy and the coffee businesses to be doing as well as they are gives a huge amount to be optimistic about, I think. And actually, it probably has a lot more growth potential than I'd maybe thought. We also covered it on our last interview with Flying Finance, where he was talking about how they've actually acquired an alcoholic brand outright, and they might start trying to do more in terms of the brands that they own. which also is another potential revenue for growth. But yeah, really, really good operator. I don't think there's anything to complain about these results if you're a shareholder. And I think given how good the results are, I think 19.5, whilst it's not cheap, I can see why someone would pay it because I think it does have a lot of growth potential still. What about you, John?
Yeah, I mean, I would agree with all of those sentiments. I think it's an attractive growth business with that strong, well, incredibly strong brand behind it. And I think particularly in, as you say, energy and coffee, they are some new paths. And obviously with Daddy Coke, they're new paths as well. But for a company like this, I think that's magnified even more so. So yeah, it's one I like a lot. I had been quite anxious about it after 2022, but actually you see the recovery and the resilience of the business and all the other markets that it does operate in. And I suppose by the very nature of the more emerging markets, you do come with some of those risks, like geopolitical risks. But no, I like it an awful lot. I was going to ask you, Sam, have you ever had shares in Coca-Cola HBC?
Haven't, unfortunately. I never pulled the trigger. It's a business that I've
Ah,
liked but never bought, but it's now a
yeah,
bit higher than it. I think it was about £25 a share before Russia and Ukraine. It's now at
yeah,
28, but you've had sort of
okay.
3% dividends along the way.
Yeah, yeah, yeah.
And then when it's
And
putting up these figures, I think if you'd held through that, I'd be pretty comfortable about it going forward.
yeah, no, fair enough. Okay, on to Glaxo then. So I suppose the daddy company that spun out Haleon. Glaxo is one of the UK's, I think it's the second largest pharma company now. It did used to be bigger than AstraZeneca, but that has since eclipsed it. In terms of their third quarter sales, they grew by 2% to £8 billion, excluding currency movements, and a 15% decline in vaccine sales was more than offset by growth in general and specialty medicines. Underlying operating profit rose by 5% to £2.8 billion, driven by revenue growth and effective cost management. Underlying earnings per share also grew by 5% to 49.7 pence, and that was ahead of market forecasts of 43.5 pence. Free cash flow fell from 20% to £1.3 billion, largely driven by the acquisition of rights to certain vaccine technologies. And net debt has fallen from £15 billion to £12.8 billion since the start of the year. Glaxo recognised a £1.8 billion charge in relation to Zantac, which was ranitidine settlement, with the vast majority of cases now settled, with all full-year guidance unchanged, pointing to an underlying operating profit growth of in the region of between 11 and 13%. The third quarter dividend rose from 14 to 15 pence, and the shares were down around 3.5% in early trading. In terms of valuation, Glaxo has a market cap of £56 billion and trades at 8.6 times forward earnings, compared with the 10-year average of 11.1, with a prospective dividend yield of 4.4%. I think when we've chatted about some of the pharma companies in the past, I think we both agree that they do come into the very technical and I suppose too hard pile in terms of really need to have an understanding of the pipeline and the drugs in the pipeline, which does require a lot of expertise and knowledge that neither of us have. I think that being said, you could take a broader view on the industry as a whole, and these are quite cyclical in the sense that there's huge amounts of research and money that's spent on the research and development of drugs. Often this can fail and it can, be hugely costly to the business. However, when they do have a breakthrough and get a blockbuster drug, then, huge amounts of money will flow while that patent lasts, and that is the nature of the business. I think Glaxo was slightly different to AstraZeneca in the sense that previously it had its consumer health division, which is now sort of Haleon and those brands, which was supposed to mitigate that and make it, I guess, less cyclical in that sort of sense. They have, Haleon's now gone. I think Glaxo has languished a bit and hasn't been producing some of those big blockbusters in the last 10 to 15 years and definitely underperformed Glaxo. I think looking at these results, they are a bit lackluster, well, certainly are lackluster. They've invested a lot in the vaccines and in HIV, but in terms of oncology and cancer, they haven't had those big blockbusters. So I think disappointing overall. It's not a company that I would bet against because you don't know what that pipeline is like and what, the next big blockbuster is around the corner. But I think the view I would take is that for someone like me as a retail investor, I would probably be inclined to take a basket approach to them and possibly, for example, in the UK, own both Glaxo and AstraZeneca. And then you've got the huge pharma companies as well, some listed in Europe. I know we've talked about Novo Nordisk, and then you've got the big US peers like Pfizer. You could quite legitimately, I would say, own 10 of them and sort of diversify that risk, but with a bet on the sector going forward. And I think that's something that I would certainly consider in my own portfolio. I did used to own Glaxo, and I don't know whether it would be in 5 years from what I'd sort of consider my legacy portfolio, wasn't really involved in it. I did want a pharma company, and it appeared sort of slightly better value than Astra at the time. But as you saw, Astra had, that valuation was justified, and they had a very strong pipeline and have done very well since. So I think that's where I would stand on Glaxo and probably the pharmaceutical industry more generally. I don't know what your thoughts are, Sam, on Glaxo in particular and investing in pharmaceuticals.
These Glaxo results, I agree, are pretty lackluster. I can't analyze the pipeline. It goes in the too hard pile. But even having covered it for a few years, whilst I can't analyze the pipeline, I can see the results of the last few years. And I think if you were to talk about the pipeline 3 or 4 years ago when we started covering it, you probably would have hoped by now something good would have come out of it. And that hasn't happened. Whether it's a year or 5 years or 10 years away, I don't know, because like I keep saying, I can't analyze the pipeline. But based on their performance, I wouldn't have a huge amount of faith in that pipeline anyway. I think they made the right decision spinning Haleon out. When you look at the PE of 9, compare that to the PE of 19 for Haleon. Why they didn't accept the 50 billion for it, I will never know. But at least spinning it out, they probably have actually unlocked some value there when you look at the difference in the PEs. I don't think I would take a basket approach because I just think, although it de-risks the individual pipelines, I don't feel like I know enough about the industries to look at them and say, well, they've got these kind of tailwinds that mean they're probably all going to grow above inflation. Whereas if you compare it to something like house builders, or it's like, well, yeah, you might struggle to pick an individual house builder, but in the UK, I don't think it takes a genius to work out that the house builders in the long term have a pretty good chance of doing quite well because of the undersupply of housing and everything else surrounding it. I don't really know what the tailwinds would be in pharmaceuticals. So other than just wanting exposure for diversification's sake, I don't see why I would think, well, actually, over the next 10 or 20 years, here's a reason I think the pharmaceutical industry is going to do really well. Do you get what I mean?
I mean, would you not think, for example, the aging population and as people living longer, having more health problems, and the pharmaceutical industry being, and people becoming richer as well, the pharmaceutical industry being there to provide new innovative treatments for those multiple comorbidities that those people, well, the population might have.
Which sounds like you know quite a bit more about it than me, to be honest.
Well,
Because I did, because I'd be thinking, well, you're also going to have like less children needing the vaccinations and stuff like that. So how much of it is it going to be offset by the fact that the population's still declining? And I don't know. It might be that they do, if you look at their revenues, they're massively weighted
mm,
towards people, say, over the age of 40 or 50. And actually, even if it's a smaller population, but with a higher proportion of elderly people, they will do better. But even then, I think it's a very, very long-term play on what I'd consider to be quite an average industry.
that's what I would just put as the more bull case for it. But that's fair enough.
But when do you think that's going to... What's the timeline? I know we are an aging population,
Yeah.
but how many years away is it from, do you get what I mean?
Yeah,
From
no, I see
the
what you mean.
population being at a point where actually the pharmaceutical companies are going to do really well. Because if we're kind of still 10 or 15 years away from that transition,
Yeah,
do
I
you
mean,
want
I
to
would
buy
see
them
it as,
now?
yeah, well, yeah, I take your point. I mean, I would see it, continuing over the next 5, 10, 15, 20 years. I don't think it's something that overnight would sort of suddenly change, but so I'd see it as a longer term trend. That being said, I haven't actually gone ahead and taken this basket approach to it. So that
But I think
I
if
don't
you
know.
compare it to, say, something like in Airtel Africa, where it's also got these long-term tailwinds, and that's actually different. That's because of sort of the growing population in Africa, the rising middle class and all that stuff. But you can actually see that in the results now. And it's,
Yeah, yeah, yeah.
the Africa is growing however, population is going up X% per year, and it might only be a couple of percent, but it's happening already. So you're benefiting from those tailwinds kind of from year one. Whereas
Yeah.
I just think with farmers, my concern is that you've got to wait a certain amount of time, really, for those tailwinds to kick in. And I don't know how
Yeah.
long that is.
Yeah, no, I mean, I take your point, and I think the other thing as well that you don't have with, say, your Airtel Africas or your Unilevers that might be, selling more of their goods in, say, China and emerging markets, is that you don't have all of the R&D costs which they have. That's, something that is always going to be difficult in the pharmaceutical industry, and I guess that is how they're compensated, when they do have patents. But it's not an easy industry, that's for sure.
Shall we move on to what probably is an easier to understand industry?
Yes, no, absolutely. So, cars, Sam,
Yes,
luxury
so
cars.
easy to understand, not so easy to operate. But Aston Martin Lagonda, we've covered them before. They have come out with their third quarter results, and third quarter revenue rose 8% to 391 million. This was driven by a 14% uplift in wholesale volumes, which helped offset 5% lower average selling prices due to changes in the car portfolio. Underlying operating losses more than halved to 21.7 million, helped by increased revenue and lower depreciation charges. Free cash outflow worsened slightly from 78.5 to 81.2 million, and net debt rose from 700 million to 1.2 billion. Recently downgraded guidance has been reiterated. This points to full year underlying cash profit margin in the high teens and a free cash outflow over the second year half of the year. Aston Martin is on track to meet the recently lowered full year guidance, and it recently refinanced 1.15 billion of debt on better terms earlier in the year, but the new debt still has interest rates in the double digits.
Oh,
Yeah, which tells you what the lenders think about the company's prospects. In terms of the valuation, there are no earnings, but we've got a forward price to sales ratio of 0.48, and that compares to a 10-year average of 1.1, and the prospective yield over the next 12 months is nil. My view is that I would not touch this company with a barge pole. I think the revenue is actually slightly encouraging, and the volumes is also quite encouraging. But the problem is, I think it's actually very similar to some of the cruise lines we've looked at, where they've just got so much debt that I don't think they have any realistic chance of paying it off. And yeah, I mean, this is not going to be a massively high margin product. I've not bothered because it's uninvestable. So I've not bothered going back and looking at what I think, although it's always had a poor record anyway, but I don't know what I think the operating margins could be if they sorted themselves out. But the debt is so high that I just don't see them paying it off. And I think although the revenue's up, the cash outflow is getting worse. So at some
mm,
point, they're going to have to go knocking on the door for more money. And I think they're just in this negative spiral that I don't really see them ever being able to generate the operating earnings to get out of. And it's not a company with the best track record for paying off its debts. So for me, I'd steer clear of it. They might drag on for a few more years, but I think this is a company that's probably going to go bust. What about you, John?
yeah, I would agree with you on that entirely. And it's a company that I don't know how many times it's been bust over its sort of 100+ year history, but I think it's certainly, is it double digits? Let me have a look. 7 times.
007?
Could be 008.
I
So
think it
yeah.
soon will be.
Yeah, I think it will. And the last bankruptcy was in 2007. And just for reference, when it went public, that was I think 2018, it was about between 17 and £22.50 a share, but then it went down to 18.50 to £20.
At £1.20 now, or £1.17.
Yeah. So it's, I think, down 97% over the last,
And the
what,
problem is as
six
well,
years.
in the last 5 years, it's never posted a single operating profit.
Yeah. Yeah, yeah,
So
yeah.
who's looking at this ever-growing debt pile, free cash flow just pouring out the door, and actually thinking it will generate? There's nothing I don't think to suggest it will ever generate the level of operating. I mean, even if it generates an operating profit based on the last 5 years, it will be a minor miracle, let alone an
Yeah.
operating profit big enough to pay down the double-digit debt and actually start chipping away at it. And then on top of that, once the debt's paid off, then you can think about rewarding shareholders. I just don't see it.
And what do you think goes? I know it's not one that, because of these sorts of results, we ever delve into too much. But what do you think goes so wrong at, say, Aston Martin compared with, for example, those other luxury listed sports cars manufacturers, Ferrari and Porsche?
Well, I think Porsche is quite an easy one because Porsche, although it is like a luxury car manufacturer, I think they make like 300,000 models a year, don't they?
Something like that,
So
yeah.
it's at that nice end where I think generally Porsches, I think it's fair to say, are not as expensive as Ferraris. It's kind
No,
of
no,
like
no, absolutely.
it's like an entry level into that market. But because of that, it's almost got, I think, a bit of a unique market position where, yes, it's not a normal car, but it's not like a Ferrari where they only make however many thousand a year and it's so few. I think
Yeah,
if you want a Porsche, you can get one relatively easily.
yeah,
So I think they're in a bit of a different position. Whereas Aston Martin, it probably is positioned more like a Ferrari. But
yeah,
in terms of the brand, Aston Martin is a fantastic brand, but it's not Ferrari is the problem.
yeah.
And Ferrari just has everything else. And I think with Ferrari, a lot of it's, I mean, Ferrari, we've never covered it on the show, but it is actually listed. You might want to have a look at. But I think Ferrari, they're doing very well since they listed, I think. And I think part of it's because they've started making more cars, but you've just got so much demand from like the Middle East or China or wherever else. It's like, as long as Ferrari can make, as long as they don't make so many that devalues it. But I think there's so much demand and they're being spread all over the world. If they used to make 6,000 a year and they're now making eight, are you really going to notice it? Because if you'd go back 30 or 40 years, if they'd done that, you maybe would have done because they're all in Western countries. But because they're more spread out geographically now, I think that's probably fine. But I think if you're some like rich sheikh or something in Dubai, you're probably going to want a Ferrari more than you want an Aston Martin. I think that's part of the problem.
Yeah.
And I think there will be some people where they just want an Aston Martin, but I think the Ferrari brand is just better in the same
Yeah.
way
So
that who owns Lamborghini?
that's Volkswagen.
I think if that was ever spun out, I think that would be more like a Ferrari than an Aston Martin.
Interesting.
I think that brand just I and the problem with Aston Martin is I don't know how well the brand translates outside of the UK. If you strip
Mm.
out the Bond connection, I don't know. Is there people driving around in America that just
Yeah.
dream of having an Aston Martin? There will be
Yeah.
some, but I think there's a lot more that dream of having a Ferrari. I think it's a branding issue.
Yeah. So for reference, in 2023, Ferrari sold 13,663 units.
So that's a lot
Port,
higher than it used to be. It
yeah,
used to be
and
like seven
Port,
or eight, I think.
yeah. So actually, if we looked back even to 2020 or 2020, that was 9,119. So they have increased it quite significantly there over the last 3 years. Porsche in 2023, they did 320,221.
Yeah, I think it's really clever from Porsche because I think the way they've positioned themselves in the market, it actually gives them a chance of having profit. I think it's hard to sell 8,000 cars a year and have the money to research them and actually
Yeah,
improve the cars and make sure the performance is there and make a decent profit. I think it's got to be really quite a special brand.
yeah.
I
And I
think,
think with Porsche, they produce drivers' cars and they're all excellent. You don't get a bad handling, a bad driving Porsche. And they've got a strong brand in themselves, as you say, with that sort of niche that they've carved out, but just quality product after quality product.
yeah, whereas with Aston Martin, I'm sure it's very nice to have one, but
Yeah.
I also think if you were to use it every day, you would encounter some reliability issues with it.
Yeah. And you find probably that you have a Porsche which is less expensive, probably faster, probably drives better, and is more reliable. So, yes, you may not think you're James Bond, but if you're in that sort of segment of the market, and then Ferraris, I guess, are so much more expensive. But at least with the Ferraris, whilst with all of these cars, you'd suffer significant depreciation. I suspect it's probably quite a lot less with the Ferraris than an Aston Martin. You might have, I'm just plucking figures out of the air, but 20% depreciation with the Ferrari in the first year. Whereas I imagine with Aston Martin, you could be talking 40, 50%.
Hmm. See how many cars Aston Martin saw? 2020, they made about 4,000. 2021, it increased to 6,200. 2022, it dropped to 1,968. I think that's probably the lag effect from COVID, in fairness to them. But if you say they're doing 5 or 6,000 a year, and they've said apparently the long-term target is to do 17,000,
Mm,
but if they've got an average of less than 5,000 a year, tripling it is actually really quite difficult, I think, because
yeah,
do you know that demand is there?
yeah, yeah, yeah,
Whereas with
yeah,
Ferrari, I think if they were to go from 13 to 15, there's almost certainly the demand there. But when you're going from 4 or 5 thousand to 17,000, it's a huge increase. And also, what does that do to the brand perception?
yeah,
I don't know if it's a similar
absolutely.
argument where they're going to be so much more geographically diversified than they maybe used to be, that everyone's still going to look when they see an Aston Martin. If 17,000 still isn't that many, I
Yeah.
think it's difficult. And I don't really think they know they have a solution.
Yes, it's a bit sad, but okay, fine. On to another consumer goods, well, brewing company, AB
Yes.
InBev. They had their Q3 results out last week. And just for reference, I know we've covered it a few times on the show before, but they're a brewer with brands including Budweiser, Stella Artois, Corona, Beck's, Skull, Victoria, and many other smaller ones. Anyway, the group reported third quarter revenue of $15 billion, up 2.1% on an organic basis, against market consensus of 3%. Growth was driven entirely by higher average selling prices as total volumes slipped by nearly 2.5%, largely due to double-digit declines in Asia. Underlying operating profit rose 8.9% to $4.1 billion, helped by more sales of premium beer, production efficiencies, and a tight grip on operational costs. Full year cash profit, EBITDA guidance has been raised from between 4 and 8% to between 6 and 8%, which is more in line with the current market forecast of 8.4% growth. A £2 billion share buyback programme has been confirmed and is expected to complete within the next 12 months. And the shares were down nearly 4% in early trading. In terms of valuation, the group has a market cap of 96.5 billion euros and trades at 17 times forward earnings compared to the 10-year average of 19.7, and currently has a prospective dividend yield of 1.8%. I mean, I thought it was definitely disappointing in these results seeing volume slip. I appreciate they've been able to offset with increasing pricing, and as with Diageo that we cover in the sector, that shift towards the premium brands, so the premium beer does help. Very disappointing, I think, in Asia, seeing things dropping off there, because I suppose a lot of the valuation is focused on the growth in those emerging markets. The other thing is the balance sheet, which has got quite a lot of debt compared with peers. It's around 3.4 times cash profits. And I know they're trying to get that down to around 2 times, but still it is quite high. I know we've talked about it before as well. Whilst they've got very strong brands, one marketing campaign that was particularly controversial and arguably cocked up led to great damage to the Budweiser brand. And I don't know. I think at 17 times earnings, comparing this to some of its peers, whether that's Heineken that now has Britvic, or I think a personal favourite of the show, which is Diageo, which has much stronger margins, very strong brands, and doesn't require such volume increases that you need in beer and brewing with the spirit market. I think Diageo would be a much better buy from my own perspective because of those higher margins and that they're able to transition more to the premium brands. So if we're looking at Diageo now, comparing the valuations, so they're pretty much on par. So Diageo is a little bit cheaper at 16.9 times forward earnings for what I think is a much better business. And that's compared with the 10-year average of 21.3, compared with the 17 times forward earnings of AB InBev. And prospective dividend yield for Diageo is also higher at 3.2%. So I think that's where I would be inclined to leave it. It certainly wouldn't be my preference in the sector. And Diageo is carrying considerably less debt as well. Sam, what are your thoughts on these results from AB InBev and I suppose comparators to some of its competitors in the market?
I think they're pretty poor. I agree. I think what's happened in Asia is really disappointing. I think even if you strip that out, I think this on paper should have been quite a good year for AB InBev because they had that terrible mess up with the marketing that you alluded to. It actually has created quite easy comparatives for them. So although they're up slightly, 2.1%, they're up against a really easy comparative. And they actually almost, decreased again. It's a really poor quarter, I think. I think if you look at the wider business, when you look at the brands, they're basically just lager. Now, I'm going to exclude Diageo because I think Diageo is actually a different type of business in that it's a lot more spirits and premium. I don't think it's as comparable, but it's with the caveat, I agree, Diageo is by far the better business. And if you just wanted an alcoholic, if you just wanted an investment that was on the back of alcohol, I don't see why you wouldn't go with Diageo. But if you wanted a more comparable one, I think it's probably Heineken. And Heineken also has, I think, as strong a lager portfolio. But I think it's also got some very good cider brands as well. So it's got like Orchard Thieves, it's got Old Moot, it's got Strongbow, I mean Bulmers. I mean, it's really some really, really good cider brands, as well as the lager. I don't know if it's got anything else. It might just mainly be those ones, beer and cider. But at least it's a bit more diversified and I feel a bit more comfortable about the brands. And it's got a lot of good brands. Whereas when you go into AB InBev's website, the main brands that you'd recognize that aren't just kind of local brands, it's Budweiser, Corona, and Stella. And we've seen in the last year, if you mess up the marketing on one of them, it can have a huge impact. Whereas I think Heineken's actually much more diversified. Whereas AB InBev just three, what I would consider quite average lager brands, although that's with the caveat that I don't drink lager. I'd never be interested in it. It doesn't really matter on the price anyway, but I think the price is quite expensive given how poorly it's been managed in the last couple of years. If I were wanting exposure to the industry, I would get Diageo first. And if I wanted one that was less at the premium end and more kind of lagers and ciders and stuff like that and more like draft drinks, I would go for Heineken. I think Heineken's better brands and I think it's better run.
On to a company that we both own.
Yes, so Upwork, it's a company we've covered before. It's the outsourcing website. They have come out with their Q3 results. Revenue grew 10% year over year to $193 million, and all these figures are in dollars. Active clients grew 2% to 855,000. Net income reached an all-time high of 27.8 million, and that's up 70% compared to the previous year. Diluted earnings per share were 20 cents a share, and that's up 67%. Adjusted EBITDA was 43.2 million, and that was up 38%. Cash provided by operating activities was 102 million, and that compared to 37 million a year ago. Free cash flow is 98 million, and that compared to 33 million a year ago. Gross sales volume from AI-related work grew 36% year over year in the quarter. Number of clients engaging in AI-related projects grew 30% year over year in the third quarter. Freelance professionals working on AI-related work earned 41% more per hour than freelancers working on non-AI related work. They've highlighted continued strength in ads and monetization, with revenues increasing 35% year over year, and Freelancer Plus subscription revenue increased 48% in the third quarter. They have announced the authorization of a new 100 million share repurchase program following the completion of the previous 100 million program. in the previous year. And that is on a market cap of $2.1 billion. So about 4%, something like that. But last year when they did it, like 7% or something like that. Well, their guidance for the fourth quarter is they're guiding for revenue of 178 to 183 million, non-GAAP diluted earnings per share of 24 to 26 cents, and that compares to 20 cents this quarter on revenue 193. So they're thinking revenue is going to drop slightly, but earnings will be up. And the guidance for the full year is revenue of 756 to 761 million. So that's up. That would be up from 689 million. So that's a decent growth rate. Adjusted EBITDA of 155 to 159 million. Diluted weighted average shares outstanding of 139 to 141 million. Non-GAAP diluted earnings per share of $1 to $1.02, and they expect stock-based compensation expense to be lower than the previous guidance of 20 million per quarter, so call that 80 million a year. So the buybacks are actually offsetting stock-based compensation, which is quite nice because in a lot of these tech companies, they do not a lot of the time. So the share count is actually going to be going down going forward, it looks like. Yeah, so in terms of valuation, the business trades at a PE ratio of 26, a price to free cash flow of 17, and a forward PE of just 16. I think these are a good set of results. The take rate is not as high as Fiverr's. So, for example, my girlfriend's been doing some freelance work on Upwork, and they take about 10%, whereas I think Fiverr takes more like something like 16, 17, and they probably take it at both ends as well. So the take rate is not that high, especially for the protection that you get from using Upwork. It probably is worth paying the 10% because, you know, if there's a dispute or something, you can actually get your money. I think it's a good set of results. However, I want the growth coming from increasing the users. It's good that they're getting more out of the existing users. And I think we have said in the past, we think there is scope to do that, but they need to be growing users as well. That being said, the figures I think are very, very good for the valuation. You've got that potential from the AI stuff. I don't know if that's a fad or not, or however, I think it's priced so cheap that if AI significantly drives growth on the platform, I think that's only a bonus. I don't think it needs to do that to justify the current price. So as a shareholder, I'm very happy with it. What about you, John, as a newer shareholder?
Yeah, well, certainly I think these results are very good. Of course, going forward, like to see more user growth, but I think it's very reasonably priced, and I'm certainly glad I did take the plunge and buy shares because it's not the sort of company with the valuation that it traded at, certainly during the pandemic, that I would normally go for. But I think you saw the quality there, and as the valuation came down since 2020, 2021, it's become much, much more attractive. So yeah, I'm very pleased with both how Upwork is doing and also Fiverr. But I think Upwork has, picked Fiverr in these most recent results. We'll cover Fiverr possibly next week or even the week after, but we'll have that for a comparison.
So of the 6 businesses that we've covered this week, Haleon, Coca-Cola HBC, GSK, Glaxo, Aston Martin, AB InBev, and Upwork, which do you like the most and which do you like the least?
It's a very easy one. Upwork I like the most, and I don't think Aston Martin is investable.
So I think for me, I do like Upwork the most. If I excluded that on the basis I already own it, I think it would be Coca-Cola Hellenic by quite a comfortable distance, actually. Least would also be Aston Martin, because I think, although I'm not the biggest fan of Glaxo or AB InBev, I don't think they're going bust anytime soon. Whereas, if you told me that I had to lock all my money up in Aston Martin shares and I couldn't touch them for 5 years, I'd be very, very nervous. I'd be very worried. Whereas I wouldn't quite have that with any of the others.
Okay. Well, on that bombshell, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.